Good afternoon. Thank you all for joining us for the 2024 Unclaimed Property Holder Seminar. My name is Jessica Keith. I'm the Assistant Chief of Staff and Director of Unclaimed Property. And we're going to start the session off with a few words from Arkansas Auditor of State, Dennis Milligan.
All right, Jessica, thank you so much. Thank you. Well, I was sitting there searching desperately for my notes. They're right up here. Yeah. Well, good afternoon, and especially a special welcome out there to all of y'all out in Spaceland. But thank you for being here today. My name's Dennis Milligan. I'm proud to serve as your Auditor of State. My team has put together a lot of hard work in arranging this seminar, and so I'll tell you, I'll be very brief. Mike Huckabee, my friend, taught me one time, he said, "Blessed are the brief, for they shall get invited back." So, but even though I hold the title of auditor, my main responsibility is not auditing. I am in charge of payroll for the state's executive and legislative, judicial branches of government, over 700 people's paychecks. Trust me when I say I don't want any state legislator or the governor calling me because their paycheck didn't go through. Many of you in this room and online don't know my background, but I come from the private sector. I owned and operated a small business for some 35 years, and I'll tell you something. People said to me before, it seems awful scary running for office or serving in office, and I said, well, the most scary thing I've ever been exposed to is trying to meet a Friday payroll. I can tell you that'll put the jahibis in you. Results matter, and so when you're in business, being able to run that business, to run it effectively, something that we have, or I feel like that I have injected into the staff at the auditor's office, is doing the very, very best job we can. And that's just built into me because, in business you either make a profit or you go broke. I mean, it's pretty simple. So, but without setting goals for myself and my team, I don't think that we would be able to expand and do the kind of job that we're currently doing. I bring, as I indicated, that business mindset to work with me at the state capitol each and every day. Have a great staff. I'm very proud. Again, I've set some very bold goals for them. I want to be known as the state auditor who has given back the most money in unclaimed property of any state auditor in history. That's a big job to do. Which brings me to the reason why you all are here today in person and online. A major part of my job is overseeing Arkansas's Unclaimed Property Program, maybe better known as the Great Arkansas Treasure Hunt. I, as the auditor, are required by law to make people aware of this program, help them return unclaimed property back to Arkansas. The flip side of this program is getting those financial assets remitted to my office, which is why we're holding this seminar today. In the following sessions, you'll hear a lot about what types of financial items constitute unclaimed property, the timelines for which property to be considered abandoned, and the ways in which you can report unclaimed properties to my office. Now, one of the difficulties we face when trying to get these monies back into the hands of their rightful owners is a lack of identifying information. Over the years, this office has received financial assets, cashier's checks being a prime example, without any identifying information. We literally have properties worth hundreds of thousands of dollars that have been remitted to my office with the owner's name as unknown, and no address or any other way to get in touch with that person. This is a challenge for my team, because even though I'm required by law to return unclaimed property to its rightful owners, I have no way of doing that in these cases. I mean, it's pretty obvious. Moreover, Arkansas law states that unclaimed properties stay in perpetuity. I was wondering if I'd be able to say that big word, perpetuity. So I think perpetuity, I said it pretty good, didn't which means that even though we have no way of reuniting these funds with their rightful owners, we're required by law to hold on to them. So here's my request. That working all right? Okay. So here's my request for each of you. Do your due diligence when submitting funds to my office. It's imperative that you include all the information you can on a person's financial property. Please be mindful that there are people on the other side of the computer screen that are also doing their due diligence and trying to reconcile these monies with their rightful owners. And I'm speaking of my call center, which they do a fantastic job. At the end of the day, it's not our money to keep. It's your money. It's Arkansans' money. So we need you to all make sure that you're submitting complete and thorough information to us so my team can do their jobs effectively. I set bold goals for my unclaimed property team and expect them to reach these goals. Your diligence in remitting properties to us is a crucial step in helping us to make that happen. I appreciate your time, attention this afternoon. And now I'll turn it back over to Josh so that we can get started. And I thank you so very much for attending again and for all of those of you online. Josh?
Thank you, Auditor Milligan, for that kind address, for leading us off so well and leading us into our future as an office with the goal of returning every dollar that comes into our office to someone. So a lot of the things that you hear today, if they're new or different or exciting, it's from that vision of let's get every dollar back to every single person that comes in. All right, let me... Looks like you've got a different set of slides up here. There we go. Little technical pause, nothing to worry about. All right, now we have our slides. Sorry for that short pause. We're going to get started off with an introduction of unclaimed property. So before I get started, by raise of hands, does anybody know what unclaimed property is? Okay, by other raise of hands, does anybody work in unclaimed property for their organization? Got a very large number of people who are unclaimed property professionals, so I'm super excited about this, and I'm sure there's even more online. So we're gonna, without ado, we're gonna go ahead and get started off with a Holder 101 that most of you are probably already familiar with. But it's definitions of what unclaimed property is and otherwise. We're going to start off with Mr. Rob Scott. He is my friend and colleague. He works as a senior manager for EECS. Let's see here. He has experience supervising and conducting both unclaimed property examinations and compliance programs for EECS. He has worked in the unclaimed property space for over 30 years, engaging with state administrators, holders, and holder advocates in connection with unclaimed property reporting, audit, and voluntary disclosure initiatives. Prior to joining EECS, Mr. Scott was the unclaimed property manager for the state of Arkansas, who I sometimes like to refer to as teaching me everything I know. He started as an unclaimed unclaimed property auditor in 1991 with the state of Arkansas and worked in unclaimed property for over 2 decades. Please join me in welcoming Rob Scott.
Thank you. So like Josh said, we're going to start off with 101, which is the basic introduction to some of the terms and what unclaimed property is and where you could find it. So what is unclaimed property? It's basically any financial asset, usually intangible, held for a person or entity that cannot be found. So any money that is owed to anybody from a company, essentially. An entity or an individual that cannot be found if there's no documented transaction or contact between the owner of the property and the company holding it. Arkansas's unclaimed property statute defines a period of time for each property type, and this is commonly referred to as the dormancy period. Here are some examples of unclaimed property that you may hold. Account balances, bank accounts, savings check, unpaid wages, commissions, stocks, bonds, refunds, utility deposits, could be insurance proceeds, cashier's checks, money orders, oil and gas royalties, and pretty much anything that doesn't fall into that category else. The one exception to the intangible property is the safe deposit box contents. That's pretty much mostly the only tangible property that would fall under the Act. Some common lingo that you'll hear them throw around in unclaimed property is a holder, which is any business in possession of unclaimed property. That could be a potential holder, and they're commonly referred to as holder. An owner would be the person or entity who has the legal interest in that property that's being held by the holder. Due diligence is a written notice to those owners at the last known address to inform them of property that will be reported to the state unless they respond in a timely manner and reclaim it directly from the company. A record is information in the custody of the holder containing the details related to that property. This could include unique identifiers such as the name, the last known address, social security number, date of birth, any other associated owners, the type of association such as joint and or. And then another one you'll hear is NAPA, which is an acronym that stands for National Association of Unclaimed Property Administrators. And this is the national group that sets the standard system for reporting unclaimed property. And Arkansas requires all holder reports to be submitted in a NAPA formatted file. For the state of Arkansas, most unclaimed property has a dormancy period of 3 years, with a handful of exceptions. There are wages, commissions, utility deposits, and refunds, which are 1-year dormancy. And there are safe deposit box, which 5-year dormancy. Money orders and shares of stock and securities are 5 years, I'm sorry. Money orders 7 years. Traveler's checks are 15 years. Some important dates to remember is the report due date every year, which must be submitted before November 1st, and it would contain property this year that would be dated prior to June 30th, 2021 for that 3-year property. If it is wages or commissions or a 1-year property, then that time period would jump up to 6/30/23. And how to know where to report it. Every state has an unclaimed property office. And if you do business in more than one state, then you may have property that goes to different states. The United States Supreme Court has determined that property should be according to the standards below. And there's a 2-tier analysis for most property. Priority 1 is the state of the last known address of that owner. In the case that there is no last known address of the property owner, then it would be reported to the state of the company's domicile or state of incorporation. And if it goes to another state, it's important to know you should contact that state, because every state may have a different dormancy period, different reporting dates. So unfortunately, they're all not completely uniform. And get to know NAPA, the National Association, who has the standard sets. The most current version you can find at unclaimed.org. Since Arkansas requires all the reports to be submitted online in this NAPA format, there are several different software programs you can use that will help you put your records into this NAPA format to be reported. And if you're looking for a free option, if you have a limited amount of records you're reporting, then you can use HRS Pro, which is up there. Or you can always enter it manually on the state's website under their Submit a Report. What does the law require that I do with unclaimed property? First, you must identify unclaimed property. And so you would look at places that you may have unclaimed property. This would be your cash accounts, checking accounts that may have uncashed checks, outstanding checks that are aged. Could be, if you're a bank, your accounts that haven't had no activity for a long period of time. And then you determine the dormancy period for that type of property you're holding. Once you've done that, you perform due diligence by sending out the due diligence letter to the owner of those items over $50. And you collect the information, then you prepare the report with all the information that you can provide associated with that property, and then you would file and submit it with the state auditor. To identify unclaimed property, as said before, you'd analyze your general ledgers to identify any applicable property you could be holding. It could also be credit balances and accounts receivable. That's often overlooked. Then once you find these records and review them, and always check the Auditor of State's website for any changes and updates that may occur in the law from year to year. This is another, we're talking about the dormancy period, and in the case where the owner comes forward and you reissue a check that they hadn't previously cashed, that reissue check, if it is not cashed, would not reset the original dormancy clock. So it would go back to the original outstanding check. So for the rules for due diligence, the owners by law must be provided at least 90 days to respond to your due diligence letter before it's reported to the Auditor of State. And all this must be performed if the value is greater than $50 and the address for the owner appears to be accurate, since this is going to be mailed. And we've got some sample due diligence letters next, and they're also provided through the Unclaimed Property Reporting booklet. So what we would expect to see in a due diligence letter would be something indicating the type of property and then identifying what they're holding for that person. So it would be the name that the property's in, the address. If it's a check, for instance, it would be check number, the date issued, and the amount. And then it should always have a disposition, and so the owner could check that they either received the check and cashed it, or they may have received it and lost it and would like it to be reissued, or they never received it, would like it to be reissued, or some other explanation. And then they would sign that and return it, and that would be your written confirmation from the owner to be able to reissue the check, or in some future, so the state would come along, they would see that yes, this was paid to the owner. Another example of a due diligence check is, for instance, of a bank or a brokerage account. You would list the account holder's name and address and what they would like to do with the account if there's been no activity. So I'm gathering your property and owner data. And as Auditor Milligan said, the more information you can provide on that property, the more likely that it will find its original owner and be paid back to them by the state. So very important information, of course, is the name, last known mailing address, social security numbers, birth dates, the relationship codes if there's multiple owners, any transaction dates, property types, and if it's oil and gas, a legal description for that royalty. Once you've done this, you'll compile that report. You'll list it by property type. You must have the owner name, if there's a last known address, social security number, tax ID number, and any other information that could be used to identify that person, such as date of birth or just anything. And then if there are beneficiaries, we ask that you please provide the name and any information you have on those, along with the description of the property, as we talked about, check, account number. And then the start date is the date the property is presumed abandoned, whether by contact, interest, activity, issuance, or otherwise. To create the report, it's basically 5 basic steps. You'll register and log in on the auditor's website. This is for a manual report. You'll enter your own company information. Then you'll enter the property information in 2 steps. You'll enter the owner information, the property details, and then it'll give you a chance to review everything you've entered. And if you agree, at that point, you'll be able to submit the report. And to file and submit a report, you go to the Arkansas Auditor of State website, and under the Report Property tab, click Submit a Report. And as we said before, Arkansas requires all holder reports to be submitted in that NAPA format. And all payments, along with that data, all payments must be received prior to that reporting deadline of November 1st. And then once you file the report, the statute also has a provision that you should hold those records for a period of 10 years after that report is filed, unless there's a shorter period prescribed for different types of companies or different types of properties. And when reporting, there's some additional notes to know. If you have a single remittance as payment, single report, you should file a single remittance for that report. In other words, you wouldn't file separate checks for each owner that's listed on that report. You would file one check for the total amount. Or if you happen to file multiple reports on behalf of entities or other companies, and you would like to make one payment for all those reports, then all those reports should be combined into one NAPA file. And any payment or transfer remitted to the state should be done prior to the submission of the report of unclaimed property. You can always get it back. So it can always be returned to the holder. So if there's a mistake or somebody comes forward and takes payment and you repay them, you can always be refunded that money. And any payment using an approved alternate option will not be accepted unless it has a written approval from the Auditor of State's office. And just receiving those funds does not relieve the company from the obligation to file the report that includes the detail and the owner information. And if you would like to have a W-9, those may be requested by sending an email to holders@auditor.ar.gov. Are there any questions? Yes.
You mentioned inactivity of bank account.
Yes.
As a possible. So if that goes 3 years, that might trigger it. So my question would be, when the bank has a inactive fee that they charge once a year, does that count as activity and restart the 3 years? Is it a vicious cycle on that?
So the question was, does an inactivity fee or other bank fee change the date, the original dormancy date? No, it does not. So it would go, the only thing that would change the dormancy date would be owner initiated activity, deposits, withdrawals, log into the account, items of that nature. Yes.
I'm sorry, go ahead. My question was, did I hear you say that we make the payment before we submit the report?
No, you can submit the report and then send payment, but both should be received by the auditor before the November 1st deadline.
Okay, but my next question is, can we not hand deliver payments, or we don't have the ability to electronically send payments?
So yeah.
How do we handle that?
I'll take this one. Yes, because this is coming from a state agency that I'm well aware of, and I remember the debacles last year. Bring it into our office, and we'll take care of you from that end. Government entities have an exclusion from the requirement of online payment.
Then you had a question?
Yes. So, if it's anything less than $50, like from a bank standpoint, what are we supposed to do with that?
So those items under $50 would still be reportable, but sending due diligence letter would not be required. Anything else? Thank you all.
Thank you, Rob. Next up, we have the person with the least experience out of every speaker up here. Well, maybe not the least, but I tout myself as the one person that's not quite as wise as, say, some of the people that are up here. So, in other words, I'm speaking for the next session. So, here we go. My name's Josh Wood. I'm the compliance director for the office. I've worked in the office for going on 18 years, and I've learned as I've gone, just like anybody else likely who started out in unclaimed property. There is no college training for unclaimed property. You learn on the job. You may be well equipped from what you learned at college to be able to use those tools in your job, but you don't know what you know until you know it. So I'm going to speak on Arkansas presumptions of abandonment. So for those of you online that are joining us from other states, this presentation is directly to Arkansas presumptions. You'll need to seek guidance from any other state you might have an obligation to report to learn what presumptions are relevant to that state or that venue. So I hope that you grabbed coffee because this might be dry, and I apologize. I'm going to try to bring a little bit of spirit into the conversation just so that we can all stay awake through this, myself included. I've had at least 3 or 4 cups of coffee, so I'm ready to go. All right. So I'm just going to pick out certain items to talk about. I'm not going to talk about everything in Arkansas Code Annotated 18-28-202. That is the statute that defines how to presume an item as abandoned. In other words, when Rob talked about your dormancy period, how long you have to keep it, that's where you start that clock. So when it's presumed abandoned is day 1, and then you allow that dormancy period to play out. So for an account, I'm going to talk through account balance, individual retirement accounts, securities, your stocks, your mutual funds, safe deposit box contents. Of course, most of you are aware, if you're a bank right now, Arkansas doesn't really accept very many safe deposit box contents any longer. We hope to address that a little bit more in the panel at the end of the 3rd session. But I'll talk about what the law says. Checks or money, and then the all-important all other property clause in the statute, which brings in certain items that the statute doesn't specify, within an individual section. So the all other clause brings in everything. So you've got your virtual currency, you've got your cashier's checks, your dividend checks, different things that aren't itemized within the other sections of the statute. So for an account balance including, say, your checking account, savings account, I don't think there are too many of these, your Christmas Club accounts or something along those lines. I think those are a thing of the past. There might still be some that are relevant, but all of that follows this presumption that it would be reportable 3 years after the earlier of maturity or the date of the last indication by the owner of interest in the property, which I believe Rob touched on pretty well on what is a interest in the property. That would be your owner-initiated activity, such as a deposit into the account or a withdrawal from the account, changing the address, a customer contacting you to change the address on the account, things of that nature. But it has to come from the owner. It can't be, say, from a regular deposit into the account or a automated withdrawal from the account for a certain activity. Say you set up something years ago and it automatically drafts every month. That wouldn't be considered interest in the account. One other thing that's not lined out in the statute that we do recognize as a good way to show interest in the account, because we're working off of a uniform code that was written in 1995. So it is a little bit outdated in this, but because it was never presumed at that point that we would be able to track an owner's login to an online account. Not 1995. It just wasn't a capability back then, but it is now. So we do recognize an owner's login to their account as a interest in the account. So the last owner-initiated interest in that account would be day one of your dormancy clock. All right, with IRAs, I'll briefly go over this and then tell you that we don't give you all of the directions or all of the instructions. Our office doesn't, as far as how to presume an IRA is abandoned and all of the property within that IRA. We do, however, have a certain statutory construct that gives direction for if there is a distribution, if the customer requested a check be drawn from that account and sent to them, or if there are required minimum distributions that are directed by the IRS. But most of the direction from above and beyond the actual plan itself, that the agreement that you have with the owner of said IRA, other than that, we would have to defer to the IRS about those planned assets. But later on in one of the questions, one of my colleagues from Boston will address some of the talk around that as well. But 3 years after the earliest of the date of distribution or attempted distribution of the property, the date of the required distribution as stated in the plan or trust agreement governing the plan, or the date, if determinable by the holder, specified in the income tax laws of the United States, by which distribution of the property must begin in order to avoid a tax penalty. So that last section, if determinable by the holder, specified in the income tax laws of the United States, by which distribution is required, that would be your required minimum distributions that the IRA gives direction on. So I have to refer you to IRA's website that gives pretty good detail on when a required minimum distribution would need to start. Generally, it's when an owner reaches age 72. On the older policies, it might be 70 and a half. But that would be, and we'll get into more. We'll get more into the weeds when we get to the panel later on in session 3. So bear with us there. All right, securities. This is your stocks, your mutual funds, any investment plan or items, so any security items. So our statute is a little bit different than most state statutes. We give you more tools in order to identify what that first date is to start the presumption of abandonment. So securities would be presumed abandoned 7 years after the earlier of A, B, or C. So A and B is the old presumption that has always been in place on the 95 Act. We didn't change that. We just added another option for C. And I'll go through each. But A and B say that the date of the most recent dividend, stock split, or other distribution unclaimed by the apparent owner, and the date of the second mailing of a statement of account or other notification or communication that was returned RPO, or after the holder discontinued mailings, notifications, or communications to the apparent owner. So that all hinges on, did you notify the person? Are you tracking that date? If you're not tracking it, you can't use that presumption. You have to go back up to the date of the most recent dividend that was accepted by the owner, or stock split or other distribution that they cashed the last check or accepted the last electronic deposit. Now, and I'll emphasize the or after B. That's why I said A, B, or C. They're not combined, or it's A and B, and then we added C as an option because the federal securities law give another way to identify that you're already required to maintain and record. So the date that the security holder or payee is presumed lost or unresponsive under the section of securities law, U.S. securities law, as it existed in 2013. So if it is ever updated, the state statute will be relevant as it was in 2013, not what it's updated to eventually. So that C, that or other item, it said that a security holder could be lost. So a lost security holder means that an item of correspondence that was sent to the security holder at the address contained in the transfer agent's master security holder file was returned as undeliverable, provided, however, that if such item is resent within 1 month to the lost security holder, the transfer agent, broker, or dealer may deem the security holder to be a lost security holder as of the day the resent item is returned or undeliverable. For whom the transfer agent, broker, or dealer has not received information regarding the security holder's new address. So it hinges on lost mail or the last time that they contacted. But there's also an unresponsive payee. So a security holder shall be considered an unresponsive payee if the check is sent to the security holder by the paying agent and the check is not negotiated before the earlier of the paying agents sending the next regularly scheduled check or the elapsing of 6 months after the sending of the not yet negotiated check. A security holder shall no longer be considered an unresponsive payee when the security holder negotiates the check or checks that caused the security holder to be considered an unresponsive payee. So if you've met the U.S. federal law or U.S. federal securities law and an item is deemed as unresponsive or lost, that could start day one of your presumption. If you have question about that or don't agree with that part, defer to A and B. So we'll get into safe deposit boxes. Like I said, it's very rare that any safe deposit boxes would be reported to us any longer, given our directions. That unclaimed, safe deposit box contents must be attempted to be sold at auction prior to it being sent to us any longer. So if they're sold at auction, there's a different way to report it as cash, and it wouldn't be sent as an actual tangible safe deposit box content. So the cash would be reported on a normal report of unclaimed property because it's an intangible item. Once you sell it, the dormancy clock resets, and then you have 3 years from that point. That's when the presumption starts, is when you sell the property. And our reporting booklet calls it excess proceeds. So the excess proceeds would be reportable 3 years after the items were sold, or any cash that's found in a box that is in regular circulation. It's not worth more than the instrument, the cash on hand. A nickel is a nickel. If you pull out a buffalo nickel and it's worth $25, then you need to try to auction it. But what the statute says, if you have something that we would accept, basically it has commercial value, and it's held for at least 5 years after expiration of the lease or rental period on the box, then it could be sent to us or reported to us. Safe deposit boxes follow a different schema, whereas the report is due on November 1, but then the contents would not be sent to us until 90 days later. But that gives us the how we can tell if safekeeping is reportable to our office, or if we can scope it out and see if an item would actually be considered unclaimed property or subject to this subchapter, would be if there is a lease or rental period. So items held at as evidence in a police locker, or items found at a hospital after a patient leaves a room, they wouldn't be subject to this subchapter. You would have to look at other statutory guidance to determine how to handle those items. Check or money, this is most of your items are going to be an uncashed check or otherwise an uncashed payable. So traveler's checks, money orders, that hinges on the date of issuance of that payment. So because those items are negotiable on an actual printed check, and that's how it's defined, then the issuance of that check is where you start day one. Money or credits owed as a result of a retail business transaction, that would hinge on the date that the property becomes distributable. So it's not the same. It's not the issue date. It's when it's actually distributable. When you have an order that says, yes, I can send this payment out, an internal process or otherwise that says this payment is owed to this person. Same goes for class action or court proceeds. There's going to be a judgment of the court that gives you a distribution date. So that's day one. It's not when you actually cut the check. It's when the judge says it's distributable. wages or other compensation would be when it becomes payable. So it doesn't matter when you send an ACH payment to an employee's account or if you cut a check and send it to them, because there might be errors in the system. There might be glitches in the system, and the payment didn't actually go out for months later. God forbid, God be it that, I hope that never happens, but if it did, the abandonment would start when it became payable, not when the error occurred and the payment never went out. A deposit or refund owed to a utility subscriber, that is when it becomes payable as well. So that gets us through the checks or money. So all of the items that don't fit into these line items could still be considered abandoned by the statute. Say your virtual currency or your cashier's checks or your dividend checks or otherwise. And I'm sure there's many things that I'm leaving out and even more that are going to be identified in future years. The drafters of the 95 Act put this presumption in here to account for things that we don't know, because like I said, you only know what you know until you know it, and then you have to know what you know a different way when you know it then. So the drafters wrote this section of the statute they left it open to determine many different ways to presume a property abandoned. So they took everything that was already written and combined it into one, and said 3 years after the owner's right to demand the property, or after the obligation to pay or distribute the property arises, whichever first occurs. So whichever first occurs, they answered it. Which one do we go with? You have to test the property out. You have to test each one of those possible presumptions and say, okay, what happened first? And that's going to carry the conversation. And I think we're pretty much right on track. I need to go back to our agenda and make sure, but it leaves us, I gave us a little window for questions and answers. So we've got about a little over 10 minutes. So pick my brain, please ask me anything. I'll try to answer it to the best of my ability. If you're answering online or asking questions online, our team will convey those questions to me as well. I hope you don't hurt me too bad, but feel free to throw them my way. Does anybody have a question in the house? Yes, ma'am.
For accounts that are court ordered for wards, minors, for like insurance money that they've gotten for an injury, and you have to have a court order to distribute any of those funds.
Mm-hmm.
If there has not been activity in that account and there is no contact information,
Mm-hmm.
no good address, no phone number, what do you do with those?
Okay, just so I understand, and I'm going to rephrase it and try to understand fully what type of item we're talking about. We're talking about a minor account that's pursuant to a judgment or court order, that there might be restrictions on how a distribution could get released. Is that correct? Okay. On something like that, I would, if it's, now I'll ask you too, is it something held in a checking account, or or it's a savings account held like a minor account for a savings account? Okay. If it with a checking or savings account, that follows the same schema as any other account balance. It could be presumed abandoned, but if the court has to issue guidance to release the funds, then that's a good one. I would ask you to give us more detail in writing and send that into our office. Send the question and give as much detail as you can, and send it to holders@auditor.ar.gov, and we'll be happy to look into that specific scenario. Okay. Any other questions in-house? Yes, ma'am.
If we have submitted a request for reimbursement to you all, how long does that typically take to get processed?
Okay, if a holder submits a request for reimbursement, how long does that typically take to receive the money back? Is that right? Okay. Generally, it's pretty quick. Once we receive the claim, the claim form, and you can go on in our reporting booklet, and it references instructions on how to request a holder reimbursement or to request a holder refund if there was an error in the payment made at the time of reporting. And it directs you to a couple forms to fill, well, one form and the instructions to that form on our website. Once you send that in with any necessary, any other documentation it says needs to be sent in, generally it takes about the same amount of time it does for our other claims that are paid out, which is generally, say, 7 to 10 business days. You'll get that money back, and it'll come to you by check, because I'm sorry, we're not in the 20th century as far as sending electronic payments yet. Don't really know how to do that quite yet and maintain a healthy box to prevent fraud around that. So that's a conversation that all states are looking at right now. Yes, sir.
Back to the IRA question.
Mm-hmm.
In relation to the required minimum distribution, as an example, let's just say that the account had a balance of $100,000 and a person was supposed to take a required minimum distribution of $4,000, and there was no communication with the person. So say for 3 years, he should have gotten $4,000 each year. What's supposed to be remitted, the whole IRA account balance, or each of the $4,000 that he was supposed to have taken?
That's a very good question. Let me scope the question out. So with an IRA account, and specifically around required minimum distributions, if you have, say, $100,000 in a plan, and then you come to the time that the IRS requires a required minimum distribution, say $4,000, and you're supposed to send that or remit that to somebody periodically over the time. It might be $4,000 as of this date, and then the next payable date there's another $4,000. Next payable date there's another $4,000. The item would be deemed abandoned 3 years after that required minimum distribution date. If that check was never sent for whatever reason, it got returned by the post office, there wasn't good information to identify the owner, different things like that, that for some reason that check never got to him or it was never cashed. I hope it was at least attempted to be sent to him the first time, but if it wasn't, and I'll ask you by raise of hands, who in here is perfect? Is anybody? I love this group. There's absolutely nobody who raised their hand, because that's right, nobody is perfect. So if you haven't been doing so, if you hear anything during this seminar that you haven't been doing or you haven't implemented as practice, you can start from day one. You can start now and start moving forward. But if it wasn't ever sent or attempted to be sent, then anything as of June 30 that fits the dormancy period for that specific property type and has been compiled to that date would be reportable the next November 1st reporting deadline. Does that answer your question?
Not really. Would the whole account balance be remitted?
No, sir.
The $4,000 to be remitted.
The account balance, the actual planned assets, we'll talk more to during the panel here in a little bit, and we might have better answers to that. But all I've really presented on to this point is the checks that have or payments that have not been negotiated. I've got a couple questions online. I'm going to read them real quick and see if I can touch on them really quickly. Let's see. To clarify the safe deposit box tangible items, we would report until 3 years after the auction of the items, even if the safe deposit box was abandoned 5+ years prior to that sale. Okay, so the 3 years after is the excess proceeds from the sale of tangible items. So that sale, that auction of tangible items would change the presumption of abandonment because it changes from a tangible item to an intangible held record. So because of that transfer from tangible item to a negotiable item that can be more easily claimed by someone, and you might have a greater opportunity to get it back to these people, and we'd love for every holder to reunite money yourself so that you can maintain that business relationship with your client. We want to give you that extra buffer to be able to get that money back to the rightful owner before it comes to us. So yes, it doesn't extend the reporting date, but the transfer of property, the type of property will determine that the property is presumed abandoned based on the sale, the auctioned off sale, and it starts a clock of 3 years, and it would be reportable as cash. Now, excess proceeds could be on that slide for checks and cash, but it would likely be called an all other clause, right? Because it's not specified individually in that statute. So yes, the 3 year would apply to the cash that was received from selling those contents. All right, but anything that wasn't able to be auctioned that is still held in the box or held at the bank, you attempted to auction it off, but nobody bought it. If there is value to that, then it would be reported on the 5-year term, the 5 years from the date that you open that box, according to the state banking requirements. So that was a little convoluted because I had to answer 2 buckets there. It's not just one bucket. There's two separate items there. There's the auctioned off contents, and there's the items that you attempted to auction but weren't able to. And there's 2 different answers to those. Next question, 202A5, demand savings or time deposit, etc., applies specifically to financial institutions. Question mark. So deposits paid to builders or contractors or professionals don't have the last contact rule? Question mark. No, they do not. The interest in the property is specifically for financial institutions, your checking accounts, your savings accounts, your time and demand deposits. There is a section below that that will preclude some items from being abandoned if you have current conversations going with somebody. Say you sent a due diligence letter and they responded back and you're still trying to work to get money to them. Maybe you've issued a check to them 3 times, but they're still in contact with you. We want you to keep talking to them. I'm sorry, I can't tell you to cut it off anytime. But keep talking to them and try to get that money back to them. If they're contacting you, if they're still aware of it, keep working with them. Don't send it to us. We don't want to get in the middle of it. That's when we get complaints to our office, either about a holder or complaints about our office trying to hold their money or taking their property. And that's not what we do. We're here to reunite money. We're not here to take it for the benefit of the state. Do we, actually, we are right on time to break. So I'm going to conclude those questions and let me confirm back to our agenda what time we're going to come back. Let's take a short break and we will come back here at 2:05. So guys, thank you. Melanie in our office, I don't believe she's in the room right now, or I will be here if you guys want to ask us any questions. Feel free to grab us. That being said, we've got refreshments in the back. There's even decaf coffee back there. There's water. There's cookies. We gave you guys labels this year, not so that we could track you so much, but so that you could get to know each other. Because let's face it, we can tell you what to do based on what the law tells us we can require of you, but we don't know what you do day to day and the problems or the scenarios that you run into day to day. So by talking to each other, you can gain a better understanding of that, and maybe you can help each other out. And that's what we're here for. Thank you, guys. All right, guys, we're back. We're going to kick off session 2. So we got one 50-minute section down, yay. Now we're on to session 2. So before we get kicked off, I want to ask you a super important question. Do you like sweet tea or regular tea? All of the sweet people, raise your hands. Sweet. That's awesome. I mean, there are some bitter folks here, but we'll get over that. All right. Next up, we have, we're going to be talking about voluntary filing options and some holder outreach methods. Some ways that the office is trying to get in contact with holders and inform them of their requirement to report unclaimed property, but not only inform them, walk them through it and help hold their hand so that they can have all the tools necessary to make that happen. And we're going to have Shawn Hibbard talk about these options for you. Shawn Hibbard, he's the director of compliance services at Kelmar Associates LLC, which is one of our third-party audit firms, one of our vendors that performs audits on our behalf. He has almost 20 years of unclaimed property experience, including performing unclaimed property examinations since 2004. I think everybody here was born after 2004, but he's been doing it a long time. He's responsible for developing programs to support clients with holder outreach and other compliance initiatives. He works closely with holders, educating and training them on unclaimed property compliance and state expectations. He holds a Master of Science in Accountancy from Bentley University, an MBA from Northeastern University, and a Bachelor's of Science in Business Administration from Nichols College. Please help me in welcoming Shawn Hibbard all the way from Boston, Massachusetts.
Thank you, Josh. Hi, everyone. As Josh said, my name's Shawn Hibbard. I'm here with my colleague Mike Gizzi. You'll meet him a bit later in the panel discussion. We work for a company named Kelmar. We provide a lot of services for states related to unclaimed property, audit services, some software, and another service that I'll talk about more on the back end of my presentation as well, holder outreach efforts. So with that, we'll go ahead and get started. A few of my goals today are to answer these questions. How can a company, how can your organization become compliant with the unclaimed property laws? And how can you report property late without penalty? I'll share some examples, 3 examples, ways that you can come into compliance with the law. All 3 of those are coupled with the ability to report without penalty. And here are the 3. They all kind of sound alike. There's a lot of similarities. There are some differences. I'll review each of those, and then I'll go back and just recap some of the differences, and you can decide what, if any of these routes make sense for your organization. First is the Voluntary Compliance Agreement, VCA. There's a Voluntary Disclosure Agreement, VDA, and then there's also a voluntary review. So the first question that you have to ask before you can do one of these 3 options is your organization eligible? Within the agreements that you would sign for both the VCA and the VDA, the holder, your company, would need to represent that it's eligible for participation because of one of the following reasons. The division or a third party acting on behalf of the division has not contacted your organization to determine compliance with the unclaimed property law or has otherwise been approved by the division. So basically what this boils down to is you're able to come forward and complete one of these reviews unless you've received some other notice from the division, whether it's a holder outreach notice, an audit notice where they're asking you to work with an audit vendor to complete a review. So those are really some of the things that could halt the process of performing one of the other 3 reviews that we'll discuss. So starting with the Voluntary Compliance Agreement, this is the most common here in the auditor's office. It's a holder-guided process. So you, your organization, your people, you'll be running the process. At any point, support will be provided by the division. Education will also be provided by the division. You'll review your books and records for the last 10 report years. You're going to hear this a few times as I go through the other options as well. 10 years is what the expectation is for all these types of reviews. You'll submit a report that includes all of your past due property, and then you'll need to include the apparent owner's names, last known addresses, amounts, dates, social security numbers, all of that information that gives the auditor's office the best opportunity to return those funds to the rightful owner. You need to report and remit within 6 months. There are no penalties, as I mentioned earlier, and then you'll need to continue to report prospectively and retain the records that support your report to the auditor's office. So that's option 1. Moving on to option 2, we'll talk about the Voluntary Disclosure Agreement, the VDA. This one's closer to an audit. It's a vendor-guided process, so you could be paired up with one of the vendors that currently works with the auditor's office. Support and education is provided by the division and or your vendor. So like I said, you'll be working with them pretty closely. You'll have a main point of contact, and you'll correspond with them if you have any immediate questions. For this review, you'll reply to vendor requests within a timely manner. So there'll be some requests that are issued, and to provide an example, maybe when you're initiating the process, the vendor may ask you for a copy of your tax return. Show your tax return, show your disregarded entities, and so that way you can scope your review, determine what entities are operational, which entities have the propensity to or could have exposure to unclaimed property. So that's one of the many requests that your vendors could ask. Review the books and records again for the last 10 report years. Submit your report, including all of that past due property. And the theme is that when you complete one of these reviews, you're kind of bringing yourself to current. So that way, forward prospectively, you'll kind of continue the process and have one report per year. Again, all of that apparent owners' names, address information, social security numbers, all of that information should accompany the underlying transactions that are included in your report. You need to report and remit in a timely manner, and again, no penalties. The third option, probably more uncommon, is the voluntary review. This one is division guided. It probably equates more to a desk audit. To initiate this one, unlike the VDA and the VCA, where you start off by signing an agreement that covers and says that you'll do many of the things that we had talked about on the previous slides, this one is initiated by providing your reporting history and other relevant information to the division. From there, they digest that information, they review your reporting history, and they'll come back to you with a list of next steps, a work plan, kind of a roadmap for what you'll need to do to complete the process to get your company into compliance. They're with you along the way to answer questions, provide that support and education. Again, it's for the last 10 report years. At the conclusion, you'll submit the report, including all of that past due property with all of the relevant information that I won't repeat for a third time. You'll report and remit in a timely manner, no penalties, and then you'll continue the reporting process prospectively. All right, so just to highlight some of the key differences between those different processes or programs. Voluntary compliance agreement, that's holder guided. Voluntary disclosure agreement is vendor guided, and voluntary review is state or division guided. The voluntary compliance agreement is attached to a 6-month completion date. The other two, you'll be working with the vendor or the division to complete the review, and as long as you're in communication with them and working through the process, you'll work out the timeline as you work through the process. For both the VCA and VDA, I mentioned you'll sign an agreement. For the voluntary review, you'll start by providing your reporting history and scheduling that initial meeting with the division. So if you're interested and you are eligible for one of these different reporting options to bring your company into compliance, what should you do next? Email holders@auditor.ar.gov. That's the best place to start the process. Josh or a member of his team will pick up that email. They'll set up a time to discuss with you or shoot you an email back. You can talk about a little bit about your company, what you're trying to accomplish, and then from there the division will get back to you and let you know which route seems to make the most sense for your organization. All right, now I'll switch gears a little bit. Those were all different efforts that you can do to voluntarily come forward and get your company into compliance. I'm going to talk about, excuse me, a newer program that involves holder outreach. This is state-initiated outreach, and it can come in the form of an email or physical mail. Some of you in the room or some of you online may have received one of these emails or letters already. The letters are directed to holders that have potential reporting deficiencies. So what can that mean? It could be that you've never filed an annual report before for unclaimed property. It's possible that you inconsistently filed annual unclaimed property reports. And to give you an idea of what that could mean, Maybe you reported in 2018, 19, and 20, but nothing has come in since. Maybe you had, accounts payable or a payroll specialist that was preparing those reports for your organization. They've since retired, they've since moved on, and those responsibilities weren't transferred. That could be why you're receiving a letter. It's also possible that you have filed reports, and maybe you even consistently file reports or file them every year, but not for all property categories that are typical of your industry. So I know we have some individuals from the banking world on. So if I could provide an example, oftentimes we see banks, credit unions, they'll report everything under checking and savings account when there are underlying properties, maybe CDs or cashier's checks, treasurer's checks, whatever it might be. All of those are grouped in and filed under the checking or the savings account code. So that could be a reason why you get the letter. These efforts are vendor guided. Our company, Kelmar, runs a program. Kroll also runs a program. But we're here to assist you through the process. What you need to do throughout to kind of get the process started is you need to acknowledge receipt of the letter that you received. We'll provide educational materials that could come in the form of a questionnaire. It could come in the form of PowerPoint slides, checklists, whatever it might be. But they're designed to help you and really guide you through that process. So that way you can perform that self-review, but understanding at the whole time if you run into a hurdle or if there's any hiccups, our teams are available to help you out. And if we do need to make the call to the bullpen, we can get back to Josh and his team to get any specifics on the statute or whatever it might be to help answer your questions. As part of the process, you'll be asked to adhere to a timeline. Generally, it's 5-6 months to complete the process, understanding that sometimes things get in the way, or there may be reasons why you need an extension. The auditor's office has always been more than willing to work with you on an extension in an effort to bring your company into compliance. The next 3 slides, I'm not going to go into too much detail on these, but it's just to show you what type of educational materials you might receive as part of the outreach process. So let's say you received your letter, you went to a website or you responded and let the vendor know that you received the letter and you're starting to work through the process. You would receive some information along these lines trying to help guide you through your review. So these are the different steps. Identify the entities, the accounts, perform that scoping to understand what your exposure could look like. Then your review gets into the transaction level detail, understanding the discrete transactions that could potentially be unclaimed property. You perform some internal research to determine, are those items truly owed? Can you determine if they're truly owed? If you cannot come up with a resolution or a disposition of those items, and that's when you would switch over to the due diligence letter process. And I know Rob had talked about that earlier. And then ultimately, at the conclusion of the due diligence process, you'll prepare your report, and then you'll submit your report and remit to the state. Again, just another example. I know you reviewed dormancy periods earlier, but the dormancy periods can get a little bit confusing where you have a 1 year, a 3 year, a 5 year, and you're running it off of an annual report date of November 1st with an as of date of June 30th. So within those educational materials, we will outline the different periods that you'll need to review. So in this example, 1 year property, payroll property, you know that you'll have to review July 1st of 2012 through June 30th of 2022. So we do try to make the process as easy as possible. And then finally, some common property types and industries. I think the point I'd make here, I'm not going to go through each of these, but the point I make here is these holder outreach efforts are often sent to hundreds of holders. So it's not just going to be a single industry. So some of the educational materials that might come across your desk may not apply to you. So within the detail, we try to tell you the different areas, the different property categories that your industry tends to have exposure to. And then you can kind of redirect your efforts and take a look at those individual property categories. And with that, are there any questions? Well, thank you.
All right, that was Shawn Hibbard, y'all. Like I said, most of these guys up here are very, very wise and have a lot of experience in what they do. Our next, I almost said our next contestant, our next speaker is from New York City. Andrew Mudgett is an attorney for Kroll Government Solutions. He has experience with unclaimed property examinations. He's been responsible for the legal aspects of ongoing unclaimed property examinations, including the drafting of reports for use by state regulators, negotiation of the detailed terms of proposed agreements, resolving examinations, and advising the legal department on any legal challenges raised by companies under examination. Prior to joining the company, Mr. Mudgett acquired experience in reviewing financial records and conducting legal research. In addition, he obtained corporate transactional and healthcare law experience. He's a graduate of the University of New Hampshire and received his Juris Doctorate degree from Quinnipiac University School of Law and his MBA from Quinnipiac Lender School of Business. So please help me welcome Andrew Mudgett to the stand.
Good afternoon, everybody. How you doing today? Good. So we've talked a lot so far about Unclaimed Property 101. We talked a lot about the definitions of unclaimed property and the presumptions of abandonment. We also talked a lot about the voluntary compliance programs that you can undertake. I want to spend some time this afternoon talking about if you receive an audit notification, and particular if you receive an audit notification to be conducted by a third party such as myself. And to basically start to finish, give you an overview as to what that process might look like. I'll do my best to identify some of the nuances and common questions that we see come up a lot of the times on opening conference calls when we're first introducing and talking about the subject matter in these examinations. And I'll spend a little bit of time talking about what you can expect as far as your role during those examinations and moving forward as well to make sure that you're within compliance of the Unclaimed Property Acts. So there are essentially three different examination types that you might encounter. Like I said, I'll spend most of my time talking about the third-party audit examination type, but to touch on some of the others, and I know my colleague before, Shawn, had touched on one of them a little bit, and that's the desk audit or holder self-review. And essentially, this is a little bit of a more casual examination. It's an examination that's conducted of your company. However, your company is going to be the one that is reviewing its materials, going through its records, and responding in large part to prompts from a questionnaire, suggesting or directing you to different places to look at within your records, asking you for information concerning outstanding checks that you might currently hold. And essentially what you're doing is you're doing a self-review of your records and responding accordingly. And to the extent that any additional questions may come up, depending on your responses, there may be requests to see information and supporting documentation, but the nature of the exam itself is not such to require you to provide supporting documentation for all of your responses. It's just a different type of review. And as Shawn mentioned before, if there are any questions that come up and we need to go back to the state of Arkansas, for example, to discuss with, we can certainly do so. And it's a expedited timeline. It doesn't take quite as long, and it doesn't quite have the same level of involvement from the state or myself as a third-party examiner as the other examination types do. And so I also mentioned the state full audit. The state has the authority and does conduct examinations themselves, But then, like I said, I want to spend some time on the third-party audit side, and that's where the state utilizes a third-party examiner, such as myself, a few other vendors as well, to actually conduct the examination on behalf of the state. And that essentially involves our role from audit authorization through to the creation of final reports. So the first communication you'll get if you're chosen to be examined by the state is an initiation letter. And what this is going to display and show you is essentially it's going to identify the entities under examination, whether it's a parent company and specific subsidiaries, or it may be a little bit more general and it may just say a particular company name, and then it'll say something to the effect of, and all of its subsidiaries, affiliates, or divisions, administering unclaimed property, something along those lines. And so it'll identify exactly what entities are being examined. It's also going to identify, obviously, the third-party examiner. If there is a third party running this examination, such as myself, it would include my contact information or whoever the relevant party's contact information is. And it would also set out specific types of property that might be included in the exam. If it's a general ledger examination, it might just say something to the effect of all property. If it is specific to a life insurance company, it might say all property, and there will be a focus on life insurance proceeds or whatever is applicable for your company and the examination type. It's also going to outline a general time period for the exam itself, such as the previous 10 reporting cycles. And so that is the initial communication that you'll receive. From there, it'll also include instructions for next steps in the examination and scheduling an opening conference call, such as to reach out to me via my contact information, where we can set up an opening conference call. That's usually what we see most often is the case. And speaking of an opening conference call, this is a meeting that we obviously start off the examination with, and it's designed to, at a high level, essentially do what I'm explaining today. It's provide a high-level overview and set expectations for what you can encounter during the exam, the types of information we're going to be requesting, and any of the logistics about reporting property. It's essentially laying out an outline of what you can expect. We don't anticipate companies to have a whole bunch of supporting documentation and materials prepped and available for this call. We haven't asked you guys to do anything yet at this stage other than have an opening call. And so what we're trying to do is just introduce you to what you might be able to expect from the exam, from, like I said, from the initiation letter, company subsidiaries, the look back period, the property types of question. It's going to include audit manager, which is the operations of the exam, their contact information, legal's contact information, and any state contact information that might be helpful. We're also going to be talking about general audit procedures. I'd say nowadays a lot of examinations are conducted predominantly, if not completely, off-site. There are times where it may make sense to go on-site, whether it's validating certain policies and procedures, but by and large, I'd say now, especially post-pandemic, it's a lot more commonplace to do a fully off-site examination or a predominantly off-site examination. So there isn't much of a requirement anymore these days for maintaining an office space for examiners to come on site. Again, this is something that can largely be done remote now at this stage. Additionally, kind of to that point, for non-disclosure agreements, this is something that we'll send out following up after the opening conference call. This is something that's between you as the company and us as the third-party examiners. And we treat, and I'll touch on this a little bit more in the next slide or so, we treat data security very seriously, and we treat your confidentiality very seriously as well. So we make sure that immediately after the opening conference call, we send out an NDA for you guys to review and for us to execute and get in place before you really start getting into the weeds of looking and responding to data requests. So to that end, about NDAs and data security, we don't transmit personally identifiable information or PII via email. we make sure that there is a secure transfer portal set up or some kind of encrypted transmission method that the company has used for its own operations, or if you don't have one set up, we have one that we can set up with our IT and your IT to make sure that we do have a secure and encrypted method for transmitting PII and other information during the examination. This is something that we take very seriously, and we make sure that this is set up right away along with that non-disclosure agreement. And so some of the initial requests that we might be sending out and we might be introducing on the opening conference call concern policies and procedures, more or less along the lines of administrative type of requests. These are more requests that help us learn more about you as the company and what might make the most sense for examining. For example, and we do a little bit of scoping after that. For example, if you are a healthcare company and all you do is administer healthcare policies, it doesn't make a ton of sense for us to send you questions and data requests regarding certificates of deposit, for example. So we try and utilize your time and our time as efficiently as possible in doing this, and those initial data requests that we send out are aimed at that end to assist us. One other thing that I want to touch on that we'll also describe in the opening conference call is reporting during the examination period. So essentially, there's almost two different reporting processes that you'll be undergoing a lot of the times. So you'll still be filing your annual reports that are due in fall, spring, summer for a handful of states, depending on which states you're filing for. In advance of filing those reports, you'll send them to the third-party examiner to take a look at and see if there's any past due property that should have been filed in a prior cycle prior to whatever the current cycle is that you're filing. And essentially what would happen then is the third-party examiner would look at those reports that are being filed, see, oh, yep, everything looks like it's currently due. It just became past due in this cycle. It's due to be reported by, for example, say this upcoming, by November 1st. If that's the case, go ahead and report. You're all good. If there is any property that looks like it would have been due in a prior cycle, that will then be reported through the auditor as part of the examination process, and will instruct you how those reportings should go with the timing and instructions there. But so you're not stopping your annual reporting cycles when you're under examination. You still want to make sure that you're doing those and submitting them on time. That's one piece that we also like to emphasize, is that the process of pre-submitting reports and pre-reporting does not delay or hold you up from getting your reports submitted on time. So just give me 1 second, because I appear to be missing a slide here. My apologies. So we'll also talk about, as we near the conclusion of the examination, what you can expect from that. And what we typically would do is review the data that you guys respond to as part of your data requests, analyze it, identify what appears to be past due property, and put together a report for you to look at and verify for us. Following that introduction and that as an overview, following the opening conference call, we'll send a follow-up letter, which typically memorializes much of what we discussed on the opening conference call. It will include any applicable state attachments, such as state contact information in case there are any issues during the exam and you would like to reach out to the state. If the state has any particular policies and procedures that they require be provided to holders during examination, those will be attached as well, along with authorization letters. But in a nutshell, in wrapping up the opening conference section, it's a high-level overview of what you can expect during the exam. And we wrap it all up at the end with this follow-up letter. So hopefully, if there's any questions, since it's a lot of potentially new information, that might be your first time experiencing it, and you have questions or you might have missed them during the actual opening conference call, it gives you an opportunity to go back through, review what was outlined, and get back to us if you do have any questions. So I alluded to this a little bit already, but as far as the data requests go, The initial data requests are, as I mentioned, more administrative data. It's your policies and procedures. It's your prior unclaimed property reporting history. And it essentially enables us to proceed as efficiently as we can and hopefully not inundate you guys with less than applicable data requests moving forward, and us to kind of tailor what it is that we're going to be asking about so that it's, so you guys can respond to them accordingly and it makes the most sense for your company and your property types. Following initial data requests tend to be more of core transactional level data requests. For example, this might include your outstanding checks on your systems. This might include what is on your UP system if you have an unclaimed property system that you maintain. This might include checks that you've voided over a certain period of time. And with these core requests, essentially what we're doing is we're trying to get to the transactional level. Your responses to those requests are going to be with transactional level data, including the dates, the owner information, the states, etc. And so this is really more getting into the weeds a little bit at this stage for the data that we'll be reviewing to ultimately determine if anything appears to be past due. One important thing I'd like to note with respect to this stage of the data and the data request is that data normalization is something that obviously helps us as examiners be able to identify properties that are actually appear to be unclaimed, as opposed to we don't have enough information to make a determination when you have to toss it back over the fence to you guys. So a lot of times, depending on the systems you're pulling from, there won't necessarily be common column headers or formatting. And so essentially, we just want to make sure that we understand what it is that we're looking at. You guys know your systems. We've maybe come across these systems before, just depending on how prevalent they are in the industry, or it may be a new system that's homegrown and we haven't seen it before. So it's kind of a back and forth. We really try and make this a collaborative process overall through this examination to make sure, again, for efficiency's sake, that we're utilizing your time and our time as efficiently as possible. So if we have questions about, hey, here's a header, do you have a data that we don't understand? Do you have a data dictionary that we can follow? There might be that back and forth as well. But again, the end game there is just to make sure that we understand what it is that we're looking at. And so we're trying not to send a whole list of properties back to you guys that, that wouldn't appear to be past due if we, had all the information available to us. So after we start getting responses in, we start doing our analysis at our end to, like I said, try and identify unclaimed property. And so based on the information at our disposal, whether it's your policies and procedures, the trigger date information, the last transaction date information, depending on the property type that you send to us, what we do at this stage is put together a report of what appears to be unclaimed property. Again, we exhaust the information at our disposal to make sure that this is as succinct a report as we can, and that we're not just spinning your guys' wheels, having you look at things that are blatantly either not yet due or dormancy hasn't elapsed yet. So we put together a report, and we'll send it to you guys so that you can look at it and verify the items on the report. One inherent issue is that there's a certain period of time that lapses between when we start receiving data and when we do our analysis and we send it back to you. So for example, you may send us data, it appears that a check is unclaimed, trigger date was over 3 years ago, no owner contact, and we send that back and hey, this looks like it's actually a past due check. You guys may have seen that since sending us the data, somebody claimed it through due diligence, or some level of activity did occur with respect to the check, or whatever the case is. There is a certain inherent refresh of data that you guys will have that we don't have just by virtue of when you sent the data over to us to review. And so we send you guys the report to look at and see, hey, did anything drop off? are these items that shouldn't be identified as unclaimed for whatever reason, and you'll give us those exception reasons, and we'll test some of those to validate that those are actual bona fide drop-offs. But essentially, we're not trying to pull the rug out from under you and say, okay, haha, we just invented a bunch of unclaimed property that you guys need to now report. We're trying to identify actual unclaimed property, and again, to make sure that we're doing it in a way that doesn't overly inflate what appears to be unclaimed property for your guys' review. And so I touched on a little bit of the analysis that we do, whether it's from a trigger date for uncashed checks, whether it's last activity date, when the check was issued, whatever the case is, because we're trying to identify actual specific transactions. In Arkansas, there is the possibility and the authority to do statistical estimation if necessary. This is something that, if it gets to this point, it's because records weren't available with respect and within the time frame for the record retention requirements, or there just isn't enough information there when you otherwise should have those records. And it's done in accordance with professional standards, and it's done in conjunction with you guys as holders and the state itself. And so, again, it's available under the statute to do so, but it is very much a case-by-case basis when in the examination itself and getting down to it, if this approach is necessary, and if it is, then how the methodology behind it. So fast forward, we send you guys a report of what appears to be past due. You send it back. We have a final population of properties that appear to be reportable to the state. At this stage, what we're doing is we are making sure that due diligence is done. If you haven't yet, you'll follow the statutory due diligence requirements, which we touched on before. And once due diligence is complete, we are preparing for filing of the reports. And so what that includes is you all prepping your NAPA reports. As we touched on before, NAPA is a uniform formatting for reporting with the states, and we're sending you reporting instructions and cover letters associated with the properties and those reports so they can be associated with the exam. And the reporting instructions, we try and do a good job to make sure that they're clear, and they cover multiple states. A lot of times these third-party examinations are multi-state. I may not have mentioned that before. So Arkansas will be a state that's part of or participating in the exam, but it may also include a couple other states, most of the other states. It all just depends on the exam itself. And so the reporting instructions themselves will also include all of the pertinent information for those states as well, to make sure that it's clear and that you're reporting property when and where it needs to be reported, and you're remitting payment via the methodologies that the states are expecting for those payments. And so lastly, final reports, the end of the examination. It's essentially what you would think it would be as a final report. What we're doing is we're identifying the methodologies that were followed, the data that we looked at. It's outlining the findings of the examination, if there were any disputed issues or record deficiencies. We really don't run into disputes very often at all, if ever, actually. But it's identifying in the final report essentially what transpired during the exam, what we found, and what we looked at, that due diligence was completed. And so this is a final report that's just generated at the examination and then is provided to essentially close out the exam itself. So that was just a very high-level overview, crash course through what you may experience if you are examined and the examination is conducted by a third-party examiner. Does anybody have any questions pertaining to those examination types that I can help answer? Yep.
With regards to statistical examination procedures, what frequency, how often would you say that happens on exams?
I'd say it's in the minority of occasions. A lot of the time we're looking at specific transactions. It doesn't come up all that often, and when it does, it is done in conjunction with the state and the holder. There isn't a hard and fast specific methodology to apply in every instance for every holder. And so again, the primary goal is to identify specific properties to be reunited with their owners. So it's not coming up as often as, like I said, identifying those specific properties. So a question came in online: how does Arkansas pay third-party auditors, contingent fee, hourly or other? Essentially, the fee schedule is scheduled that it depends on the amount of property that ultimately gets reported. There's a percentage that Arkansas pays to the vendors. From those findings, it isn't a payment that's done from, for example, the company that's being audited. You guys aren't paying for that, and based on those findings, it's done via contingency from a percentage from the ultimate findings. Does anybody else have any questions? All right, thank you very much.
All right, thanks, Andrew. Thanks for taking the bullet on that. How do you pay audits too? And that was an excellent answer. We've got just 5 minutes left before we go to break. If you guys have any other questions, or I can give you a little 5-minute presentation on something else, I'll leave it up to you. I would love for you to fill me up with a few more questions, but if not, I'll fill the 5 minutes. So I'll give you 10 seconds. Chirps. All right. Just give you a little, Kurt, can you go to the third session? That's on here, isn't it? Well, I'll just give you a quick overview. Why we ask certain things be done the way that they're done. We may ask a little bit differently than other states. We may, when Auditor Milligan first came into the office, and I know he alluded to it in the introduction, but he came into the office with an open mind. He said, I want to return every single dollar that comes into this office to everyone who we're responsible to pay. I want to get it all back. I don't care what the government says or the budgeting institutions say. I want to return every dollar to every Arkansan or everyone who's due money. So that opened up our minds and kind of made us open our minds in a way that we had never done before. So we were looking at property types differently than we have ever looked at it before. Including this past year, a lot of banks and credit unions have heard about new things that we're requiring or requesting or full-throatedly recommending with regards to cashier's checks. Because historically, that's been an item that may have only been reported to us in payee name with no mailing address. So the only real way that an owner could get that money back is if they brought us the cashier's check and they showed us that cashier's check so that we could pay them. Now, we don't know if the payee actually ever received that check or if they're still due money from the remitter of that property. By remitter, I mean the person who requested the check be issued. By payee, I mean the person who the check was made out to. So many states ask for cashier's checks to be reported to the name of the payee. We did that for years, not really understanding what we were asking. And we educated ourselves this past year to what a cashier's check is and why it's what is preventing it from being claimed. So our efforts now are how do we return this money to the bank or the credit union's customer. It's not hinging on payee or remitter any longer. It's the bank customer. That's the person that you're going to know who this item, you're going to have the best information for this check. Maybe one of your register only has the cashier's check number, the name of the payee or the remitter name, and an amount of money that's due, because that's how you're identifying if it's still outstanding. So what we would ask you to do is isolate those items that are still outstanding and then pull in information from other bank account, the bank account that they have or the savings account that they have, that the bank is required to know it exists before they can issue said cashier's check. So we're asking you to give us all the information that you have on your customer. That will give us the best opportunity. That will give the banks and the credit unions the best opportunity to get that money back to somebody. I've been very surprised and to hear credit unions and banks on the phone say, "I didn't know I could return this to my customer." And that's partly our fault, and that's our fault. And state administrators, we didn't understand the property fully. We didn't understand what it was, what it meant, and so now that we've done a little bit of review, I know many states, well, I shouldn't say many, some states have added on requirements that both the payee and the remitter be reported. We ask that, yes, both payee, it's not in our law, it's not in our regs as of yet, I say yet, but we do recommend full-throatedly that for a cashier's check that's being reported, you report both the payee name and the remitter name, and conduct due diligence to the bank's customer, and pull in all information from that customer's account. Or if the check was issued to a vendor, pull in all of the information that you have on that vendor that you're sending the check out to. Because in some cases, the customer might be the payee or the customer might be the remitter, depending on what type of check is being written. But if we hinge on customer rather than payee or remitter, we're going to hit home to where we can most likely get that money back to someone. I hope you agree, and if you don't, feel free to reach out to me directly. My phone number in the office is 501-371-2103. If I don't answer, leave me a voicemail and I'll get back to you as soon as I can. I'd love to have those conversations with you, and I look forward to working with you guys going forward, getting money back to Arkansans or to other people in other states, because sometimes that gets reported to us. But we're going to take a 15-minute break, and we'll be back here. I just want to confirm the time. At 3:10. So that gives us about 13 minutes. So feel free to walk around, talk to each other, complain about what we're asking about for cashier's checks. Please complain to me, not to other people. That'd be great. But we'll come back here in 13 minutes. We got cookies in the back. We've got the good coffee, and then the coffee light, the decaf. If you have a problem, if you can't go to sleep, if you drink after 2 o'clock, that's available back there too. But bathrooms are around the corner towards the elevators up here. But catch Melanie. Melanie, say hi. Melanie is my assistant. She can answer any questions that you have, and I'll be around here too, even after the third session. Just catch us and ask any questions you have. Thanks. All right, guys, we're going to get started with session 3. We've gotten we've gotten 2 50-minute sessions out of the way, and now we've got momentum. We're going into some of the more exciting items, and I'm looking forward to answer some of the questions that were submitted to us at registration. That's going to be fun. But so session 3, we're going to go over some any legislation or litigation that's taken place within our state in Arkansas or maybe surrounding states. We're not going to bring into scope any litigation or legislation all the way around the nation. But we want something that's relevant to companies in Arkansas or companies that deal with or that do business in surrounding states as well. So we might look at some of the past issues, but generally mostly relevant to Arkansas itself. So with that, I'm going to bring up Andrew Mudgett again. He's our I'll call him our resident attorney. He gets to give us a legislative and litigation update. Thanks.
Hello again. To Josh's point before, we had the momentum. What bodes well for this presentation is that much of the first several slides we've already touched on regarding what is unclaimed property, certain presumptions of abandonment, and so I'll do my best to work through those a little bit quicker so as not to be overly repetitive from what you all have heard from the first session and even into the second session. So I'll touch on some of it, talk about the statutory law via the Unclaimed Property Act and the Unclaimed Life Insurance Benefits Act a little bit, and then I will also pivot and talk about some legislative updates and some recent case law developments as well. So by now, I think you're all very familiar, if we weren't already going into this afternoon's overall session, what unclaimed property is. Essentially, it is property that has not had contact or communications, depending on the property type, associated with it for a certain statutory period known as the dormancy period that is set out via the statute, whether be it expressly for certain property types or even implicitly via the catch-all provision of the Unclaimed Property Act. And so I won't spend a ton of time harping on that specific point since I think we've already talked about it a lot, but here are some of the more common types of unclaimed property that you might see in, for example, the banking industry. You might see utility deposits, stocks, bonds, money orders, cashier's checks, to name a few. And you might also see, if you're not in the banking industry, other property types such as accounts receivable credit balances, disbursements such as accounts payable or payroll, depending on if the state allows for that. And so there are a few different property types that you might encounter, and it really is and boils down to industry-specific types. So we talked a lot about the different dormancy periods and what the different trigger dates might be for some property types. I want to take a moment to talk specifically about checks and voided checks at that end for the trigger dates. And so depending on your industry, what you might see is a check that's issued to pay a client or a patient or whatever the case is, and for whatever reason, that check ultimately gets voided. It could be via your policies and procedures, a certain amount of time has passed where you just automatically void the check. You may automatically reissue it, or you may not reissue it automatically. And so for whatever reason, the check gets voided and subsequently reissued. And a lot of the times the question then becomes, which of those two dates should you use as the trigger date? And it depends. So the issue date, generally speaking, will be the original issue date, generally speaking, will be the trigger date that you should use. In the case of, for example, an automatic reissue, if a check is issued, then voided, and then you reissue it and there hasn't been, communication with the owner or contact or anything along those lines, then you would still certainly be using the original issue date as the date the liability arose. One nuance to that would be if you reissue a check based on a request from the owner themselves. If they've communicated specifically about that check as such that it might restart that dormancy period. And so that's just one nuance to consider with the voided checks, depending on how the check ultimately gets reissued. If it's done just automatically via your policies and procedures, or if there's certain actions that are taken by the owners to, cause the check to then be reissued. And then for some reason, if it still after that point remains unclaimed for another, say 3 years. So that's one nuance that I think is worth a mention with respect to the dormancy periods. Again, dormancy periods vary by property types. The most significant for Arkansas, outside of obviously the expressly mentioned ones for travelers checks, say 15 years, money order 7 years, is what's known as the catch-all provision and the presumptions of abandonment. And that is a 3-year dormancy period for properties that aren't expressly identified to have other dormancy periods. A lot of vendor checks, for example, will fall within this catch-all provision where they don't have an outright explicit mention in the actual act itself. And there's certainly other property types as well, but that is one of the more common ones that you may run into. So we talked a lot about before also about your compliance requirements for reporting. Most businesses are to report before November 1st using a cutoff of July 1st through to June 30th of that preceding year. And the exception there being life insurance companies. Those companies use a spring reporting cycle, so the reports would be due before May 1st, and they follow a calendar year. So a little easier and a little more straightforward to determine, it's, today, September 30th. If I have a life insurance policy that became unclaimed today, it would then be reported in this upcoming May 1st, 2025. A little trickier just mentally when you're thinking about the cutoff dates for the July 1st to June 30th cutoff, but it follows the same principles and it follows the same logic. And the holder reporting booklet, I think, does a good job of also identifying the different timelines so that if your property became reportable within a certain threshold, it then tells you what the corresponding report date would be. I think also that's worth noting, though, with respect to these compliance requirements is the $50 aggregate threshold for reporting. So for items that are less than $50 each, those items can be reported in the aggregate. Those items don't necessarily need the accompanying owner address, owner name, social security number information that otherwise is required if available as part of the normal compliance requirements for reporting generally. So there is a $50 threshold there for reporting in the aggregate. Similar in the sense of due diligence, there's a $50 threshold there for conducting due diligence. There's a $50 threshold for aggregate reporting as well. Speaking of due diligence, we talked about this before. Properties less than $50, you don't have to do due diligence for, following the due diligence requirements, the statutory requirements. Also, if your records disclose it to be a bad address, for example, that's another instance where you wouldn't have to do the due diligence. So you'd be conducting property due diligence for properties that are at $50 or more. Records don't disclose the address to be inaccurate or not barred by a statute of limitations argument there. So I'll switch gears now a little bit and talk about some of the legislative updates. And again, at this stage, they aren't super new anymore. A lot of the changes to dormancy periods and the implementation of the Unclaimed Life Insurance Benefits Act, these transpired in 2015 and 2017, but they are still certainly notable, and particularly if to, I think, a point that might have been raised earlier, if your person in charge that had been in charge of reporting and UP compliance for a number of years had left, and the responsibilities lapsed and weren't picked up by whoever is the new person at the firm. These may be still worth noting and updating policies and procedures to the extent that you haven't looked at them in a while. And so 2017, a number of dormancy changes were made to certain property types. There were a number that were left unchanged, but I'll highlight a couple of the few that were updated at that time. One of them being bonds, switched from a 5-year to a 3-year dormancy. With that being said, the dormancy trigger remained unchanged. Dormancy still runs from the date of the most recent interest payment that has been unclaimed by the owner. Savings account and CDs, similar to bonds in the sense that the dormancy trigger itself didn't change, just the requisite time period for it to become abandoned changed and decreased from 5 years to 3 years. Demutualization proceeds for insurance companies, another example. This dormancy trigger is from the earlier of one of two things. It's the date of last contact with the owner, and is the date, or is the date property became payable or distributable. And I think lastly here for specific property types, stocks, interestingly enough, didn't decrease from 5 years to 3 years. They actually increased from 5 years to 7 years. And the dormancy trigger for stocks is one of three things. It is the earlier of the date of the most recent dividend, stock split, or other distribution unclaimed by the owner, the date of the second mailing or of a statement of account or other communication or notice returned as undeliverable, or the date the payee is presumed lost under SEC regulations. And so stocks being one to note that actually increased while all the others, I should say, decreased more or less. Speaking of decreases, that catch-all provision that I mentioned before, that one decreased from 5 years to 3 years. And so a lot of these vendor checks or other property types that aren't otherwise expressly identified within the actual act itself would fall into this category. And of note, this is now a shortened requisite time period. Here's an example of a handful of property types that remained unaffected by the dormancy period changes. They include payroll and wages. Those are still 1 year. Money orders are still 7 years. And so just to illustrate, it wasn't a fully sweeping change for all property types. It was a handful of property types, but most notably the catch-all provision as well. And so the next couple slides that I'll point out here are essentially screen grabs from what's available within the actual reporting booklet itself. And I find these to be very helpful for people that, especially people that are doing reporting for the first time or maybe reporting for a new state for the first time. And in this instance here, you can see that what's up on the screen right now are miscellaneous property types. And you have the dormancy period in the leftmost column for those specific property types. You have the NAPA codification for the state of Arkansas here, and then a description of what the property is. And highlighted are just a couple of some of the more common property types that you might see in banking, for example. And so as you go through the reporting booklet that Arkansas provides, identifies all of these different property types and codes that they'd be associated with, such as the miscellaneous ones, the account balances and insurance. And you can see that for all the ones that are on the screen here, it's a 3-year dormancy period. A lot of threes will be found in the reporting booklet by association with that fact. And then you have uncashed checks. There are certain vendor checks there, CK13, 3-year dormancy period via the catch-all, but again, 15-year for traveler's checks, and then minimal proceeds and securities. And so this is just to show a few examples where you can identify some of the more common property types for your industry within the reporting booklet itself. And so also within the 2017 amendment were some changes to the due diligence requirements. This might have been touched on before, so I won't spend a ton of time, but essentially due diligence increased from 60 days to 90 days at a minimum for owners to reclaim their property items. And so due diligence would be conducted no more than 180 days and no less than 90 days from the filing of your annual unclaimed property report for most property types. And again, the old requirement was 120 days and 60 days. So another implementation that took effect in 2015 was the Unclaimed Life Insurance Benefits Act. And I want to spend a little bit of time talking about this because it's separate from the Unclaimed Property Act, but it works in conjunction with it. And so essentially, via the Unclaimed Property Act, you have, a certain dormancy periods established for life insurance policies and proceeds. And what the Unclaimed Life Insurance Benefit Act does, though, it in part requires a semi-annual comparison of your life insurance products against the Social Security Death Master File or another comparative comprehensive database with source of death information. And essentially what this is doing here is requiring you to run a twice-a-year comparison of your in-force policies to identify if a insured had passed away, and which would then, of course, trigger any date of death, unclaimed property events based on the policies themselves and what is stipulated for distribution payments there. And so it is separate from the Unclaimed Property Act, but again, it works alongside it, specific to life insurance proceeds. And it remains separate again to the extent that if there's violations with the Unclaimed Life Insurance Benefits Act, it's not necessarily handled via the provisions of the Unclaimed Property Act. It's potentially subject to the Unfair Trade Practices Act. And so just to illustrate that it's two different acts working towards similar or common goals, but again, doing so in conjunction with each other and not necessarily following under the same specific umbrella. So I'll spend a little bit of time now talking about case law and a recent update with respect to recent litigation. And so we talked before about the priority rules, and the first priority rule is property is escheated to the state of the owner's address. And the second is that if the owner's address is unknown, then it's the state where the company is incorporated or domiciled. And so that's established at common law via case law for Texas versus New Jersey. And that essentially stands true till to today. There have been a couple cases that have also looked at it in the progeny of Texas versus New Jersey. But one case that kind of calls it into question a little bit is the MoneyGram litigation that was recently decided back in early 2023. And that's an instance where Arkansas and a coalition of several other states were challenging Delaware's view on the priority rules as it related to specific MoneyGram official checks. And so essentially here is MoneyGram, we'll call, as the case refers to them as disputed instruments. These MoneyGram checks were being escheated to the state of Delaware via the common law priority rules. And the question being posed was whether they should be escheated pursuant to statutory priority rules under the Federal Disposition Act, or even to look at the common law priority rules overall themselves. And so I want to talk a little bit about what the court in MoneyGram did and what they didn't do. And so in MoneyGram, these specific disputed instruments were decided that they were they fell within the purview of the Federal Disposition Act because they were similar to money orders. And so essentially all these properties that had been reported to Delaware were found that they could have been reported to other states because under the Federal Disposition Act, the place for escheatment is the place of purchase as opposed to the state of domicile or state of incorporation where addresses aren't available. And so a big question became, is it a state of incorporation or is it the place of purchase for these specific instruments? And so the court found that the MoneyGram instruments were subject to the purview of the FDA and therefore escheatable to the place of purchase. What the court declined to do in MoneyGram was opine on cashier's checks. And the court also did not define specifically what a money order is, because the MoneyGram instruments themselves fell within the similar to category of under the FDA's definition. And so, again, the court declined to opine on cashier's checks specifically, but what the court did in its reasoning for determining whether the MoneyGram instruments were subject to the FDA was establish a two-part test where you look at if the prepaid written instrument is used to transmit money to a named payee, and then the second prong being an equity prong, and that there would be a disproportionate escheatment to the state of Inc. due to certain record-keeping gaps that are inherent in the property type itself. And so that equity prong is really interesting, and it opens up the opportunity for there to be arguments about where ultimately the escheatment should be for these similar written instruments. But like I said, the cashier's checks themselves, the court declined to opine on those particular issues, and so it kind of remains to be seen whether the escheatment would be to the place of purchase, because the MoneyGram litigation itself didn't specifically set precedent for that property type. And I know that a question has come up online about how to treat cashier's checks, and that'll come up a little bit later during the panel where that question will be addressed. But the conclusion for MoneyGram's sake, at least, is it depends, because again, this wasn't a product or an instrument that was ultimately weighed in on. So last thing before I wrap up, I'll talk a little bit about the unclaimed property, the different unclaimed property model acts. Arkansas follows, let me take a step back actually. So there is a commission known as the Uniform Law Commission, which is a nonprofit organization aiming to promote clarity and uniformity across the states. And so they've drafted a few versions of model acts to effectuate that end. And the Arkansas Act, the Arkansas Unclaimed Property Act, closely follows the Model Act from 1995. Every state's a little bit different. There are certain similarities for each state's Unclaimed Property Act, but there are also certain nuances between them. The state doesn't necessarily have to implement word for word verbatim what the Model Act is. There are certain provisions that are, subject to what the state would like to implement. And so Arkansas, for example, follows the 1995 Act. Other states may follow the 1981 version of the Act, or even as recently as 2016, the revised Uniform Unclaimed Property Act, otherwise known as RUPA. And so RUPA is currently enacted by 13 states. It adopts some of the language and some of the treatment of certain aspects that the 1981 Act did, such as the look-back period, the 10-year statute of limitation. The 1981 Act had a 10-year look-back limitation. The 1995 Act kind of pared that back a little bit and addressed properties specifically identified. And so RUPA kind of took a little bit of the 1981 approach again. But what RUPA also did is start to identify some forms of new property, such as payroll cards or virtual currency. And again, like those property types, this virtual currency specifically, it's kind of an evolving landscape. And we'll touch a little bit more on that later during the panel, but just something to be aware of if you have property that's reportable in other states outside of Arkansas, that there might be similarities between those states' unclaimed property acts, but there also might be some nuances that are important to take note of. And so best practices, takeaways are to do what you can to stay current on developments in the act, whether it be amendments, changing dormancy periods, make sure your policies and procedures are current, and you implement those as to the best you can, and check for updates to the rules themselves. So with that, are there any questions that I can help answer? Okay, thank you.
All right, thanks, Andrew. Next up, we're going to have our communications team come up and give you a quick inform you on some new things that they're doing to get money back to the rightful owners. So, Jordan, if you wouldn't mind. Boom.
Hello, I'm Jordan Gipson. I'm the outreach coordinator for the state auditor's office. We work, like Josh said, for getting the money back to our Kansans. That's our priority, and we work in tandem with y'all. Y'all report the property to us, and it's our job to pick up the baton from there. First of all, I just want to brag on outreach and our UCP because they have been really knocking it out of the ballpark. Dennis Milligan, like you've already been informed, he's really a go-getter. He wants this money out. He wants it out bad. We've returned $55.9 million back since he took office. That's pretty impressive. It's been a chore doing that, but it's amazing the feedback we get from doing this. We've actually done over 63,000 claims since he took office in 2023. So we're pushing as hard as we can to get this money back. Different methods that we've tried. Our communications director, she's been a front runner for this, trying to find a way to get everybody to know about these programs. When I first started, I would constantly have constituents be like, "You're a scam. We don't believe you. Blah blah blah." And just from all of the letters we've been sending, the phone calls we've been making, and all of that, I've noticed just in the past year, nobody's asking me those questions anymore. I call them, we notify them, and 9 times out of 10, they're on it. Okay, yeah, we understand. We got this money, and they're processing that money. Like I said, we've been trying to go above and beyond. The biggest issue we've ran into has been lack of information to be able to track these people down. That's why we're here, so that y'all can help supply that information for us to pick it up. The unknowns are the biggest problem for us. The unknowns that come up, we don't have enough identifiers to be able to get this information and get it to them or their heirs. And we appreciate y'all coming and being online and trying to take this and get it corrected, so that we can get the money back to the constituents. That's where it's owed. Other than that, I don't have a whole lot to say. As far as reporting the properties or actually claiming the properties through Arkansas, it's going to be www.claimitar.gov. And for anybody that's not from Arkansas or has property that might be outside of Arkansas, please check out missingmoney.com. That's the national database, and that's where you would go to be able to get property. So make sure you check for yourselves, your friends, your families, churches, schools, any entities that you have, because 1 in 4 Arkansans are owed money, and I know other states it's probably even more, especially bigger states. So we want this money back to y'all. So let's all keep doing our due diligence, just like us, and we appreciate y'all being here today. Thank you so much.
Thanks, Jordan. Also, the auditor wrapped out our SUV. The state office had a vehicle at our disposal going into this administration. They fully wrapped it out. Just look at our Facebook page, and you'll see different pictures of it driving around to different parts of the state. It's pretty amazing, and it gets the message out just by seeing it driving down the road. It's pretty awesome. But with that, we're going to take just a brief 5-minute recess so that we can get set up for our panel. We're going to move a couple things around and get some chairs set up here, and we're going to answer some questions that you guys submitted at registration, but also we might allow a couple questions for you guys if we have time to fill it in. All right, thank you. All right, guys, we're back. I'd reintroduce our panel here, and I haven't gotten the opportunity to introduce Mike Gizzi. He is my colleague he's a managing director for Kelmar and Associates. He's got over 25 years or almost 25 years of audit experience in managing audits and managing teams. Like I said, this is a very wise panel, and I'm just kind of overwhelmed that I get the opportunity to sit with them. We've got Shawn Hibbard with Kelmar, Rob Scott with EECS, and Andrew Mudgett with Kroll. And my name's Josh Wood. I'm the compliance director for the state auditor's office. So with that, we're going to kick off our panel. We're just going to answer a few questions that you guys presented at registration, and then we'll open it up if we have time. First question: what more can holders and administrators do to ensure that holders provide all of the account identifying information needed to increase the probability that the administrator can maximize the return of property?
All right, I'll be taking this one. I think first, if we look at the administrator side, part of why we're all here today is to take part in that educational process. You bring forward the issues and concerns that you have, gathering information. Josh's team is sharing issues that they have when they're trying to return property, namely unknown property. So that educational process is key on the administrator side. As far as holders and what you can do, I think it's really taking a lot of the information that you've learned here today, educating yourself through the website to understand those different fields, those different pieces of information that are useful for returning property, and then translating that into your policies and procedures, developing best practices, and then making sure that those make it out to the individuals at your organization to make sure that they're collecting that information when they have the opportunity. So.
Thank you. All right, second question I'm going to take, and I'm going to quickly breeze through this because I had the opportunity to talk about it at the end of the last session. But how should cashier's checks be reported to the office? I'll quickly read a quick memo that we released some time back when it first came to us, after we had the opportunity to look through it. Our office's primary goal is returning unclaimed property to its rightful owners. Cashier's checks are an area where there is room for improvement. We recognize that some of those improvements will require internal work here at the auditor's office. We're currently making internal changes intended to streamline that claims process for cashier's checks. However, the primary hurdle for successful cashier's checks claims remains banks' practices when reporting those checks. At present, our office is in receipt of more than $8 million worth of cashier's checks with no provided owner information. This means the reporting bank failed to provide a name for both the remitter and the payee, either leaving both fields blank or manually typing unknown in one or both of those fields. It is difficult to imagine a scenario where a bank issues a cashier's check yet retains no information, including a name, for either the remitter or the payee. With that in mind, we ask that the banks include both the payee and remitter when reporting cashier's checks. Moreover, if either the payee or the remitter was ever a bank customer, we ask that the bank provide all available personal identifiable information for those customers. This will maximize our chances of reuniting the unclaimed funds with the rightful owners, or it even gives the banks a better opportunity to return those funds before it is ever reported as unclaimed property. Let me move on to number 3. Is virtual currency required to be remitted? If yes, what are the steps and dormancy period?
Yep, so I could take this one, Josh. So virtual currency can become abandoned. This is, however, an evolving landscape. Currently, Arkansas doesn't have the means to accept virtual currency. And for those who may not be aware, virtual currency can include crypto, Bitcoin, items of property types such as those. And so Arkansas currently doesn't accept virtual currency in its native form, such as a Bitcoin being reported as a Bitcoin. That being said, it can take custody of the liquidated portion. If they are liquidated before reporting, then the state of Arkansas can and will take the liquidated assets. But again, this is an evolving landscape. As I alluded to a little bit earlier, the 2016 revisions to the Unclaimed Property Act, RUPA, start to address virtual currencies. And so states are slowly becoming, or are slowly identifying this issue specifically. But as it currently exists for Arkansas, the native forms of those virtual currencies wouldn't be reported.
Thank you. All right. How should property held in a qualified retirement plan be reported to the state of Arkansas?
Yes, earlier Josh talked about IRAs, individual retirement accounts. Here, for qualified retirement plans, we're really talking about tax advantage, deferred benefit plans, deferred contribution plans. A deferred benefit plan, and something like a pension, deferred contribution plan, something like a 401k plan. To be a qualified plan, you have to meet certain requirements of the IRS and of ERISA. ERISA is administered by the U.S. Department of Labor. ERISA is short for the Employee Retirement Income Security Act of 1974. And ERISA's main purpose is to protect retirement assets. There's a school of thought, and certainly the DOL has had several opinions on this matter that says ERISA preempts state unclaimed property law. So, again, several DOL opinions on that. We heard about the ULC, the Uniform Law Commission. The Uniform Law Commission has concluded otherwise. So when the ULC has drafted Model Acts, the ULC has said ERISA does not preempt state unclaimed property laws. Property is still reportable to the states. That said, I think Arkansas, as well as several other states, right now, for the current time, are not requiring holders to report undistributed account balances. So if there's an undistributed account balance in an ERISA-governed retirement plan, because of tax and other considerations, the state is not requiring those to be reported. However, if there was a check that was dispersed out of the plan, so 401k checks, those are required to be reported, as are any undistributed account balances for a terminated plan. So those are the two instances, I think, where the state and most states are probably saying, go ahead and report the checks, go ahead and report the account balances if it's a terminated plan. And you haven't taken some other sort of disposition, such as rolling that that plan asset over to an IRA, for instance. So, kind of a two-part answer. Report the checks, report the undistributed account balances for terminated plans. But if it's a sort of a live and existing plan, no real requirement at the time being to report those account balances.
Thank you. All right, let's jump into how should time deposits, say account balances, CDs, or minor accounts, be reported to the state of Arkansas?
Yeah, I'll take this one. So time deposits, which includes CDs, would be reportable after the earlier of 3 years past maturity or an owner-initiated contact. We're talking about owner-initiated contact. We're talking about either deposit, withdrawal, or an owner logs into the account would be an example of that. And we can't really use returned mail if there's no mailings. So if you're mailing out with not returned mail, then not returned mail would be evidence. But if there's no mailings to the post office, if it's all electronic, then we obviously wouldn't have return mail, so we would go by a last login or affiliated accounts of the owner where there is activity. And it would be the same for minor accounts.
Has there been any consideration of bounced emails? That's really easily determined and tracked nowadays. So when you send the email that your statement's available and it bounces, it's 2024.
If the email bounces back, we would ask you to send something through the mail. Let's see. Jump into, please explain how disbursements from mineral interests should be reported specifically for deceased owners.
Yeah, I mean, I think the short and simple answer is, the same way, you would report, and prior to reporting, perform due diligence if you believe the owner was alive. Arkansas doesn't have any sort of exclusions for reporting differently right now. I think maybe baked in this question, because we did get some other questions that, are related. I know that there were questions about, are there shorter abandonment periods, for instance, if you know that somebody is deceased or a mineral owner is deceased. And in some states that is the case. Some states, a few, Idaho, Illinois, Florida, Tennessee, they have a shorter abandonment period, generally speaking, if you know that the owner is deceased. Arkansas does not have that, but Arkansas has what I sort of consider, the ultimate expediting reporting of mineral interests, and that is what they refer to in their handbook as pay to current. And what pay to current means is if there is a disbursement that goes unclaimed, it meets the required abandonment period, it gets reported as unclaimed property. Subsequent distributions are also reportable, and you don't have to wait the 3-year abandonment period. So once the first payment, or disbursement in the string becomes unclaimed, then so are all the subsequent payments to that same owner.
Thank you. All right, let's say, are negative reports required in Arkansas?
So this is a quick answer. Yes, negative reports are required in Arkansas. If you were to navigate through the state website and you go through the reporting property section, if you want to file a negative report, you can't do it through the manual report option. You'll need to do it through the upload a report option. So that would be the only nuance to that.
All right. And here is the question that probably had the most responses at registration. How do you submit a payment to Arkansas? And I'm going to answer this in a few ways and cut it out, because a payment might be the cash that's being sent in to reconcile a report, or it might be the shares that are sent in that are payment. Say mutual fund shares of stock that are being reported, or they might be safe deposit box contents that have been reported. So a payment can be loosely termed as all of that. So one of the questions was, what shares does the state accept? The short answer is any share that is worth greater than a penny per share could be accepted as unclaimed property and could be reported. Now, if it's valued less than a penny per share, our reporting manual considers that a worthless position, and because it's valued lower than what it would cost to liquidate it and return it to the customer. In many cases, as you may know, in our reporting booklet, during last year's filing period, we went to an online-only pay. So the payment method is by ACH debit or e-check, or you can pay by credit card. The credit card comes with the ordinary fees that any credit card charges its issuing party. That being said, we don't have the opportunity that, say, your local grocery store does to mark up an item or to cover the differences between that at checkout. So the state can't pay for that for you, so you would pay a small fee if you were paying by credit card. That being said, if you choose the e-check model, it is free. The state assumes the cost of that in the ordinary process, knowing that it is less expensive for the check to accept and pay for an e-check transaction than it would be to manage the receipt and reconcilement and returning of any checks that are issued in the normal and when I speak to remitting the payments and say the changes that we made, the thinking outside of the box with cashier's checks, coming up with better ways to identify, the reason that we came to this conclusion that it is better to receive an online payment and to receive an online report. That being said, an online report, if we receive a payment, a report has to be submitted first, and then any subsequent payment can be made to the office. We have to have a record to accept an item before we can accept a payment for it. And that goes back to the Arkansas Constitution. We have to maintain a reconciled budget every fiscal year. So we can't have any outstanding payments at the end of a fiscal year, and it shouldn't be our responsibility at the end of a fiscal year to make a run to every single holder that failed to perform their duty in submitting both the report and the payment. So if we take control of the process and put a filter in place that you can't make a payment until you submit a report and we accept said report, then we can confirm that we are maintaining a reconciled environment. But why do we do that? It's so that we can return money more effectively, efficiently, and quicker to people, so that we can get it back into the hands of Arkansans in a much more efficient and quick way. So some of the statements, now, before I read a couple of these statements, I'm gonna lead off with, in my opinion, unclaimed property is the greatest set of consumer protection laws in the nation. NAPA puts it this way: the purpose of unclaimed property laws is to protect the public by ensuring money and property owed to them is returned to them, rather than remaining permanently with financial institutions, business associations, governments, and other entities. Another party, Alston and Byrd, who is an audit defense attorney that helps some holders, they put it this way in one of their newsletters. They said, state unclaimed property laws are informed by consumer protection policies, given that they are designed to prevent property owners from loss of their property interest or to reunite owners with such property. And they go on to say companies need to understand the strong consumer protection interests that inform state audit programs and other enforcement efforts, including expanding enforcement authority and mechanisms. And some of the stories that come in, I've worked in the state auditor's office I'm in my 18th year, and I started out in the claims section. Some of the stories are really heart-wrenching. They really touch your heart whenever you get to the conclusion that I'm going to be able to pay you money. They've all got a reason. They've all got something that they're going to use that money for. They didn't know they were getting it. It's a gift just to be able to get reunited with their money. But one person in an article with Good Morning America put it this way. He was a security officer, and he was reunited with $100 that he had forgot he ever had. And his response to a reporter was, I got a little something something. I'm going to go fishing with it. I mean, that's a real comment, and you can feel the passion behind it. It's like, I didn't remember that I had that. But the why to us is what it means for you and your loved ones to get money back that belongs to you. So that's why we do it. We don't do it to make it hard. We do it because we hear we hear from many different people on the other side of it that need us to do it better. They want us to be able to get their money back to them. So with that, I'll go with number 10, and then if we have a few extra minutes, well, we might have about 30 seconds after this. But is there a website that provides reporting instructions?
Yep, so you can go to each state's website will provide that information, but you can also find that information on NAPA's website. They centralize that for you. But again, if you're looking for additional nuances and get in the weeds a little bit, each state's website will be able to provide this information for you.
Hey Josh, sorry. Hey Josh, we've got one question online. So Charles asked, does Arkansas let a holder offset a liability owed to an owner with the amount that the owner owes the holder? You want me to ask that again, or? I know it's a hard question to ask. So does Arkansas let a holder offset a liability owed to an owner with amounts that the owner owes to the holder?
That is an easy and complicated question that I don't want to get into the weeds on here, because depending on who I'm answering that in front of, it may be a more difficult question to answer one off. So I would highly recommend whoever answered that question send an email to holders@auditor.ar.gov. Thank you. All right, now we'll open it up to the room, and Jordan is going to be walking around with a mic. So if we have any questions here, we can do that for a few minutes.
Just a real quick question. Arkansas has casinos now. What happens with the unclaimed tickets, uncashed tickets?
That depends. Now, is it something that, say, you walk into a casino and you've got a card that shows what your remaining balance is, that they're tracking you and they know how much money you have on this card? Or is it just a ticket that you have that there's no identifiable information on?
It's definitely going to be a combination of the two, but a lot of them, a player uses their card, places a bet, doesn't cash the winning ticket for whatever reason. It expires within 60 to 180 days, depending on the law. The other one is you're in a slot machine, you've got your rewards card in there. It can easily be tracked back to the player who cashed out that ticket. What are the casinos actually doing with that money?
Yeah. I'm not going to get into the weeds on that answer, but I will say that if there is money due and there's an obligation to pay that person and they're able to identify that person, that it should be reported as unclaimed property.
I think Nevada requires it to go to the state unclaimed property. I just wondered what
Yeah.
Arkansas did.
NAPA, what we had talked about, National Association of Unclaimed Property Administrators, does have a webinar on their page that walks through that conversation as well. And many states have contributed to that conversation.
You mentioned that the state would accept stock certificates as property, I believe, didn't you?
Stock certificates are mostly a thing of the past. Now on private issues, a private entity that controls their own is their own custodian, and they only transfer stock via certificate. We do have a mechanism to accept that. That being said, most companies have moved to book entry at this point, but some do report or can only trade via certificate.
Okay, let's just say it is book certificates that you would take if you held them for a couple of years and then the owner was located. Would he receive the stock or cash?
That depends on if we've sold it yet or not. Our statute allows for to liquidate shares upon receipt. and that was put into law in, I believe, 2021. But it just depends, have we sold those shares as of yet or not? Any other questions? Any online questions? No? All right, mum's the word. Thank you guys. Thank you for spending your day with us. We really appreciate it.